Today I would like to analyze Lockheed Martin, one of the largest aerospace manufacturer in the world and one of the companies that might benefit from the current conflicts in the world. We can see here the stock price is up around 31% in the last 5 years, but if we're going to take a look at the 1-year chart from the highs in 2024, we are down around 22%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 110.25 billion US dollar. This makes Lockheed Martin the fourth largest defense contractor in the world by the market cap. We also have a dividend yield of around 2.81%, which we can see here did grow in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 65.4 billion US dollar. This was a good growth around 9% from 2019. In 2021, we saw the decent growth around 2.5%. In 2022, we saw the decline around 1.5%. This is something we don't like. Then in 2022, we saw the decent growth around 2.4%. And 2024, we saw the good growth around 5%. So overall, it's a check here in the revenue growth in the last 5 years, but the growth was not very high. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 6.4 billion US dollar. This was a good growth around 10% from 2019. In 2021, we saw the good growth around 20%. This is something we like to see. But then in 2022, we saw the decline around 20%. This is something we don't like. Then in 2023, we saw the decent growth around 1.5%. And in 2024, we saw the decline again around 15%. So this is something we don't like to see. So overall, in the last 4 years, we didn't have the free cash flow growth. So it's not a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. This is around 5.29 billion US dollar. We're going to divide it with the current market cap, 110.25 billion. Then we're going to get the free cash flow yield for 2024. This is around 4.79%. which is a good free cash flow yield in my opinion. So it's a check here for 2024. But we can also calculate the free cash flow yield for the next years. If we take a look here, the assumptions for 2025 is around 6.5 billion US dollar. In 2026, around 6.6 billion US dollar. And in 2027, around 6.99 billion US dollar. So let's assume for 2027, around 6.7 billion. So we're going to take this number. Then we're going to divide it with the current market cap, 110.25 billion. Then we're going to get a free cash flow yield for 2027 with our assumptions. So the number we're going to get would be around 6.07%. And that's a very good free cash flow yield, I would say. It would also be a check here for 2027. So let me know in the comment section if you think these assumptions are realistic. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 19.63 billion US dollar. We're going to add the short-term debt as well. This is around 0.64 billion US dollar. Then we're going to divide it with the current free cash flow, 5.29 billion US dollar. And then we're going to get the ratios that we're looking for. So the number we're going to get would be around 3.83. And that's a decent number, I would say. In a little bit under 4 years, we can repay the debt with a free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much cash this company has in the bank, around 2.48 billion US dollar. I think it's a decent amount. So overall, I think this company has a decent balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, $110.25 billion US dollar. Then we're gonna add the debt as well. So the debt is around $20.27 billion US dollar. We're gonna take minus the cash. The cash is around $2.48 billion US dollar. And then we're gonna get the enterprise valuation, so how much the whole company is worth. So the number we're gonna get would be around $128.04 billion US dollar. So this number we're gonna divide with the current free cash flow, $5.29 billion. And then we're gonna get the ratio that we're looking for. So the number we're gonna get would be around 24.20. And I think this is a decent valuation. It's not an indication for undervaluation right now, even though the number is under 25. So it still would be a check here. Well, we can also calculate this number for 2027 with a free cash flow of around $6.7 billion US dollar. So then we're going to get a different number. So the number we're going to get would be around 19.11. And that's a decent valuation, I would say. It's again under the 25 that we're looking for, so we like to see that. But overall, I think this company does not look extremely undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look and we can see here, yes, this company buys back a lot of their shares, sometimes even over 5%. So these are big amounts. This company buys back a lot of their shares. So we like to see that it can help the stock price to increase as well. And it's a check here. Can Lockheed Martin stock be a good buy right now? The stock price is down around 22% from 2024. So let's start with a positive about this company. We had a decent revenue growth in the last 5 years. The balance sheet is also decent. The debt amount is not too high, and we also have a good amount of cash on hand. The free cash flow yield around 4.79% is also quite good. This could be an indication for a fair valuation. In 2027, with our free cash flow assumptions, the free cash flow yield would be around 6.07%, which is quite good in my opinion. The enterprise valuation to free cash flow ratio around 24.2 is also quite decent. We like to see that number under 25. So in 2027, with our free cash flow assumptions, this number is around 19.1, which is quite good again. We also have a dividend yield around 2.81%, which is also quite good because we have a very good growth rate in the last 10 years. What we also like to see is the shares outstanding decrease. This means the company buys back their own shares, and this can help the stock price to increase. So overall, I think this company looks quite good. What I don't really like to see is a bad free cash flow growth in the last 5 years. This is something very important, that the free cash flow can keep growing in the future. But overall, I think this company could be a fair valuation right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.